the fact that inflation has fallen and it's likely to remain below the RBI 4% target for the next 6 to 9 months. And I think that has opened up a space for the RBI to ease in a way that had not been possible for the last couple of years. So I think this whole disinflation has played a big role in what they've done. And my sense is, going by the commentary of the governor in the press conference, once the inflation problem is in control for now, he's now fully focused on growth. And in fact, he actually said it in as many words that price stability is not the only objective of the RBI. Once prices are stable, then RBI will focus on growth and prosperity. By the way, these are things, I've not heard the governor say in the past. So these were sort of, I think reflection of a new RBI. But my sense is that the plan is not just to raise growth now, but also to take steps which actually raise structural credit growth and structural GDP growth in the economy. And cutting the CRR rate, which is generally seen more as a structural tool and not a tool for cyclical changes, is exactly for that reason, that they want to give a push to credit growth for the medium term.
I see. The changing of the stance from accommodative to neutral, Pranjul, that was a bit of a head-scratcher, wasn't it? Does that imply that the front-loading that we saw means the end of the current easing cycle?
Well, I do think it means that we are not going to see such aggressive and sharp action from the RBI. But I don't think it means that, there's no more easing in the offing at this point of time. At the end of the day, the neutral stance means that you can go either way. And if in 3 to 4 months from now, the RBI realizes that inflation is even lower than its 3.7% forecast, which, by the way, is our view, we think it will be much lower, it will be closer to 3%, then maybe RBI can cut again around December, which again is our forecast.
How do you think the trade deals work into this? Because some may believe that this is going to strengthen the hand of India's negotiations and negotiators at the negotiations table in securing a US-India trade deal. Does this put India in a position of strength, in a position of power?
Well, a good question. And, I don't think it really impacts the negotiation, which anyway is going on. But I think it impacts India's ability to gain following the negotiation. If India can actually get some concession, which gives a boost to mid-tech manufacturing like textiles, footwear, toys, then all eyes will then be on the domestic economy, ease of doing business, low interest rates, to actually be able to do something out of that opportunity. So my sense is that the government is working, and the RBI, they're working together, and they're working on many fronts. One front is basically, getting the trade negotiation with the US done. The other front is to ensure that once that is done, there is a nice sort of domestic stage on which new manufacturing can take off.
Did you feel, Pranjul, that this decision was informed by last year's macro and markets event? Did that perhaps scare the RBI into acting as aggressively as they did on Friday?
Well, there was a sense that liquidity had been kept tight for a long period of time and rate cuts could not happen. All of that was happening last year. And there were good reasons for that. Inflation was still quite elevated last year. But as soon as inflation fell, the RBI realized it's time to change things around to really, reduce the cost of funding at this point of time. And I also want to make this additional point. When you want transmission to happen, which I think is the number one short-term goal of the RBI, then you need banks to be happy. And I think what the RBI did on Friday is not only did they bring down the cost of funding, which is via repo rate cuts, it also did the CRR cut, which will help banks maintain some of its NIMs, which the banks were getting scared about. When rates fall too aggressively, then their NIMs can get impacted. So CRR helps to counter that. So this is like a nice package that they brought together to actually handhold the banks in the process of raising structural credit growth. But I think the main objective at this point is transmission, which in turn will raise credit growth and therefore GDP growth.
But there wasn't anything in this decision that hints at some sort of potential or incipient credit event or a non-performing loans event or a household debt crisis or anything systemic that is happening, Pranjul, does it? Is that... I'm just trying to... It just seems like something of an overreaction to me. If there were excesses building in the system, then why go so far as a 50 basis point cut?
Right. I think this whole worry about excesses building into the system was a story of last year. And it was tackled last year by raising risk weights in personal loans, in keeping liquidity tight, in not cutting rates as aggressively. And I think the new RBI, the new governor, and also a new deputy governor, it was Poonam Gupta's first policy meeting. I think they took the call that all of those problems have been solved for now. But right now, we should prepare for the sort of next credit takeoff. I think that is what has really guided this move. There's a lot of front loading that has happened, and of course, it has come as a big surprise. But my sense is that the rate cuts, we were anyway expecting 25 plus 25. So they've just done it together, 50. That's not the bigger surprise. The bigger surprise is the 100 basis points CRR cut, which will infuse 2.5 trillion rupees. But even there, if you look below the hood, you'll see that India has about $45 billion of FX swaps maturing over the next couple of months. And some of this liquidity injection will help sterilize the impact of that. So it's not going to really add to liquidity in a major way, given all of these FX swaps that are maturing. Yeah. So if you look beneath the hood, you can sort of see sense in the actions.
So, if this is about making sure the transmission mechanism is ticking over nicely, then at what point are we going to see the desired effects in the broader economy? At what point are these measures, whether on the CRR or the headline interest rate, the repo rate, that cut, when are they going to start to bite in a positive direction, Pranjul?
That's a good question. I think what the RBI is trying to solve is the supply of bank credit by all of these rate cuts and liquidity. But eventually, you need demand for credit to rise as well. And I think that has been soft recently. It's been soft for many reasons. I think a lot of people are not taking housing loans anymore the way they were last year. The informal sector is doing better. So they're not taking all of these distressed consumption loans either. So both the investment and consumption demand for loans has moderated. I think eventually, once interest rates are low, once trade deals around the world are signed, FDI starts to flow again, investment begins to rise, then on its own over time, demand for credit will also rise. But I don't think it's going to happen very quickly. I think it is something that will take a quarter or two.
How do you characterise and quantify the balance of external risks, and how do you think the RBI are quantifying and characterising the balance of external risks? And is there a strategy here that they want to build enough of a buffer or a cushion and protect the economy from any potential black swan event or exogenous shock should it arise?
Yeah. Look, for now, my sense is that the rupee is a little more flexible than it was over the last year. And I think that is important because that then becomes the primary shock absorber. If there's, like, for example, a big crisis event globally, the rupee will depreciate and at once, provide some support to India's exports. So it's important to let the rupee be flexible because then it becomes the first shock absorber at a time when there is global uncertainty. And I think, the RBI is doing that. I think the rupee is a lot more flexible right now than it was in the past. Of course, the second is that you want to build back FX reserves. But, that may not happen very quickly. I think FX reserves are already pretty high. The governor spoke about how it's 11 months of import cover. But if RBI wants to build it further, I think that will take a little bit of time. And the one thing I'll be watching out on the external front is capital inflows. Net FDI inflows in weak, portfolio inflows have been uncertain. And, I think that's sort of the one thing we'll need to watch out carefully.
That's a great point. You preempted my next question, Pranjul. And India has still a relatively low ratio of exported goods to GDP. But how much is riding on a successful conclusion of what could be historic trade deals with the EU and, of course, the United States? And what would be the net effect on trade flows, portfolio inflows, and stickier FDI commitments, and, of course, the crowding in of private capex you would think ought to follow?
Great questions. And, this is an area we've been tracking very carefully. I think India has generally done well on exports of high-tech items like mobile phones or drugs and pharmaceuticals, automobile parts. But where India has lagged is all of these mid-tech exports like textiles, footwear, leather bags. These mid-tech exports are actually more labor intensive. They create the jobs that India needs. And I think there's a realization in the last couple of months that, hey, why don't we take this as an opportunity to actually, give a boost to mid-tech exports? And I think that's what's happening. If you look at India's trade deal, which was signed with UK a couple of months ago, it gives a shot in the arm to textiles. Maybe, there'll be another shot in the arm for these kind of sectors with the deal with the US and EU. And that's the area I'll be watching out for. A rise in mid-tech, in FDI, mid-tech investment, and mid-tech exports out of India. I think that will increase India's exports to GDP ratio.